Here you go, study. I'm studying the ICT concept. Got nothing to do, so I'm just studying right now. All right, we got the light. Wow, so bright out. All right, let's go study up. Damn, I am so bright. This thing is so bright. What the heck? All right, so we're just going to be studying the ICT concept. That is the plan for today, is just to study it up and learn. I'm on the 2024. If you haven't watched the other ones, make sure you guys go look it up. Right now, I'm on the 2024 now. I mean, I just got back in the market 2 weeks ago. So I'm just learning so far, like the rest of you guys. If you guys are traders trying to understand how the market works, but that's pretty much what I'm doing now. So let's get this thing started. Let's get it started. So this is the mentorship. Wait, the heck? What? Oops, sorry guys. Let me fix that up. Let's learn it together. If you guys are traders, excited for you guys. How do you get the volume? It's so long. It's been a while. All right, I'm ready. I am ready.
That tells you if you have that and any wick in there, just completely disregard it. Only if it's a wick that's below the consequent encroachment, which is the halfway point here. So any wick that reaches up to that level or less, ignore any of those wicks. You have to take it to the body of the candle. Okay, so that gives you the true, real fair value gap, or in this case, a SIBI, sell side imbalance, buy side inefficiency. All right, so that's the business there, and extend it out in time. And the market goes right up to that high and then folds and creates what right here? What is this? That's that fair value gap between this low and this candle's high. And you see it trade right up into consequent encroachment plus a little bit more. Why? Why? Because the algorithm is affording anyone that uses this information, that uses this level as an entry point, they have to offer them the spread, right? Or they won't get their fill. And that's why you get this little bump right above right there. But you're going to be told that that's buying pressure. The buying pressure just happens to stop at levels of precision that fit inside the narrative that I've proven to you over and over and over again with live price action before it happens. Folks, as we go through this, that onion, okay, that sits in the skull of yours that you think is a brain, I'm going to be peeling back those layers and getting rid of all that crusty shit, okay? And we're going to get down to the sweet kernel in the middle. And you're going to find out that there really is an algorithm. And it really is absolutely 100% manipulated and controlled and scripted until they manually intervene. And then it seems like the markets are random. The markets are controlled by buying and selling pressure. Wrong. Absolutely not. So you have all of these levels here, and I'm going to leave it up to you to have a color scheme that you like, okay? Meaning that you're going to come up with the scheme, because people are always like, can you show us the colors that you use for your candlesticks? I get nervous when I see stuff like that, because I know invariably what that means is there's somebody that wants to start putting their charts out like mine. and they want to put my videos and clips and whatever on their Instagram or their other social media, whatever, and pretend that they did these trades when I'm recording myself doing them. And then they can't show something after the fact or explain it in hindsight because now they know that the move happened. They can't have their charts look like mine because they won't match the color. So it creates a problem for them and they're fraud. So I don't sit down and try to show you the actual hue or color of here. In fact, these charts may actually become a different color, and the background may change also because it's starting to bother my eyes. And even with the blue filters that I have on, it's a little irritating. But you want to go through the charts and you want to highlight these things. And since we have done this work up here, where we had relative equal highs here and here, what did I teach you yesterday? How do you know it's a high probability relative equal high? When the right side that is identified as a potential turning point for a quote unquote potential relative equal high, the right one is going to be slightly lower than the one on the left. We have that here. We don't even need to see this ahead of time. We just need to see, okay, it ran that, and you might identify it after it does that run there. And then you start seeing it break down. See that? At the turning points, or potential turning points like this, okay? This is where, and I'm going to refer to this in my book with this lecture here. I've taught and introduced inversion fair value gaps on Twitter Spaces last year, okay? All of my PD arrays have an inversion aspect to them. Every single one of them. Every single one of them can reverse their role. Every single one of them. But it's not easy for you, and it's not easy for people that want to try to teach my stuff for money when you're actually getting it right from the source here for free. It's not easy for them to be able to teach that because I've never went into great detail like I will in the books. So that way it kind of like bridges the gap. And then you'll see everybody start teaching it then. But this is a note that's real important for you, okay? Inversion fair value gaps, the highest form of precision, the ones that are really, really trustworthy, the ones that have the highest degree of working in your favor, depends on your understanding of what I taught you yesterday and what I'm building on here. Whereas we have an area that's smooth after 7 o'clock, so the 7 o'clock in the morning starts the AM session. So now you start hunting on the 15-minute time frame, the 5-minute time frame, and the 1-minute time frame. You're hunting relative equal highs and lows to form after 7 o'clock. Well, we have that here. You may not have had the experience to anticipate this run up. That's fine. You don't need it. You don't need it. Remember when I first taught breakers? I taught that on baby pips back in 2011. Yeah, I think it was 2011. If it wasn't, it was 2012. The idea of waiting for a stop run and then wait for the market to come back down in to the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt, and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now remember what I taught you. A down close candle that is a fair value gap is a SIBI. A up close candle right here, this is the opposite, which is a BISI. B-I-S-I. Buy side imbalance, sell side inefficiency. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. This fair value gap here, if you don't understand what you're looking for and you don't have the element of time, Dave, and you trade back down into this fair value gap, you might be lulled into thinking, well, wow, this is an opportunity for me to take one of those ICT fair value gap buys and go long. And then it's to your detriment that it reverses and collapses on you. Understanding that it's 7 o'clock, post 7 o'clock, we have relative equal highs. It rallies after, remember the new week opening gap I talked about yesterday? You're going to discover, Caleb, that your model is going to be gravitating towards those new week opening gaps. That's your model. You're going to be trading in that direction. But before we get to that, you have to be able to look at small fluctuations around segments of time that will have a repeating phenomenon, that they all look very similar to one another. It's a fractal, okay? But the fractal element is only repeating and verifiable on the time frames I'm teaching you to focus on right now. We're not going anything higher than the 15-minute time frame. But this buy side imbalance, sell side inefficiency, that fair value gap, is going to have a role reversal where everyone else that thinks they understand it because they didn't introduce to it lightly, that is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. Now, I'm going to slow things down here because I already know some of your heads are spinning. You're like, dude, you said this is going to be easy. You're not complicated. But what I just said is not complicated. You have to look at these specific times of the day. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's giving you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this. But my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. I want that. That's the one I want. Everybody else might be trading down here, and they might get a fill right there. And they won't be comfortable trading into this high here or right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there, that right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. It's right there. And then this becomes a selling point. And now what do you have at this point? You have this low and this low. And what time of day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So let me slow you down because you're getting a little panicked, I'm sure. This is too much information, my head's spinning, ICT. All you're doing is you're looking for areas where they can stop people out and go the other direction. That's essentially all you're doing. And you're looking for little periods of price action where Obvious highs can be targeted. Obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. That means things that we've been coloring here with the rectangles. Okay? Your eye will jump to them with experience. You'll see them more the more you do this. And because of that experience factor, you'll learn to filter out some of them because they've already been used several times. It doesn't mean that they won't be used again. It just means that the ones that are unfilled or left in a state of imbalance, like this portion of this gray box here, from this candlestick's high to that candlestick's low, there's a little bit of inefficiency. And graphically, it looks like this. That's the remaining portion that's inefficient, that little segment up there. It doesn't mean it can or needs to fill it right now. It's just that's the part that my eye goes to. But you still want to have the low, the midpoint, which is consequent encroachment, and the high. You want to have those levels all the time because they will refer to them. If the price is trading anywhere around this range here the rest of the day, watch and see how it uses it. It will use it again. So if you want to talk about support and resistance, these inefficiencies are the real support and resistance in price action. You'll see them, kiss them, turn on a dime, go right to the level, stop, turn around, the bodies of them stop. Like it's so precise. It goes without question. It's laughable for anyone to say there isn't an algorithm. These price engines, what are they referring to? Think about it. What are they referring to? If it's an algorithm, it has to refer to something it's happened in the past. So what I've done is I've created a language where you're either going to be reaching for old highs for the express purposes of taking out or engaging that liquidity that would be resting above it in the form of buy stops, or going below a low or equal lows for the express purposes of going down to engage the sell side liquidity or sell stops. Outside of that, what are we left with? Anything that's inefficient in terms of price action. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point, because it's going to trade right back up into that. And if you go back and look at your examples, maybe you've taken trades, whether it be live, demo, whatever, or maybe you've done some annotations in chart work and journaling, and you were focusing on studying on the breaker. Go back and see if this signature doesn't appear in some of them, and maybe some of the things that you would have taken as a trade there, or maybe you've taken and got stopped out. This was the factor that you didn't see it happening. And notice that this is the only buy side imbalance, sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs until the narrative is outside of that, what are we left with? Anything that's inefficient in terms of price action. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, And then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point, because it's going to trade right back up into that. And if you go back and look at your examples, maybe you've taken trades, whether it be live, demo, whatever, or maybe you've done some annotations in chart work and journaling, and you were focusing on studying on the breaker. Go back and see if this signature doesn't appear in some of them, and maybe some of the things that you would have taken as a trade there, or maybe you've taken and got stopped out. This was the factor that you didn't see it happening. And notice that this is the only buy side imbalance, sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs until the narrative is likely to change bullish. Your focus goes to only looking for sell side imbalances. That means a down close candle that has a segment with the previous candle's low and the subsequent candle after it has a high that doesn't connect. And the only bridge between those 2 points is the down close candle in between. That's your fair value gap. And it's specifically a sell side imbalance, buy side inefficiency. And by having that, what that does, it removes the ambiguity. And it gives you a very specific process of saying, okay, I'm only focusing on these specific fair value gaps. I get that question a lot, even with private mentorship students. How did I pick that one? Why did I pick that one? Why didn't I pick this one over here? Well, that comes with experience. And it may seem like a cop-out to some of you that are just straight ass hats and you don't really want to take the honest truth. There's some things that you're going to have to get with experience. And I don't make any bones about it. I don't sugarcoat it. And you're going to pick it up because you've been doing it long enough. But to get that experience that's required to do a lot of things that you're asking for answers, you got to do what I'm showing you here. And you can do it after the fact. You can go back and look at it. And yes, you have the added benefit of hindsight. Don't discourage yourself in that, because anything you learn, every surgeon that ever did a surgery on you, they studied in a book. They watched other surgeons do it first. Then they worked on a cadaver. It's a dead body, okay? Where if they cut some artery or something, they make a mistake, the person's not going to sue them for malpractice or die on the table. They're already dead. So they're demo trading with a corpse, okay? Or they're demo surgery with a corpse. But when you start looking for it, there's specific fair value gaps, Caleb, that I want you to focus on, okay? The very first fair value gap prior to a stop run, always have that one noted. And that's why it's colored red here, or pink if you want to call it that, because this is a change in a direction. And what this is doing is acting just like an order block. It's just change in the state of delivery. Oh. So I'm incorporating narrative where the market goes up after 7 o'clock, stop hunt, change, breaks lower, comes right back up into inefficiency, but to a very specific fair value gap. It's the first one prior to a stop hunt. Okay? There's going to be lots of times where this doesn't form, and that's okay. If it doesn't form, what do? Throw everything out the window and start trading supply and demand and Elliott wave, because nothing's going to work for you. I had to toss that in there. Because some of you are falling asleep. You're like, oh, dude, he's droning on. I don't know what's going on. This fair value gap, okay, if it's not there, then you use the breaker. It's very simple. It's the last down close candle, okay? But your stop needs to be above the highest high of the consecutive down close candles, because this is all the bearish breaker, both of these candles here. So your stop has to be above that, okay? How much? Two ticks maybe, 1 tick. Many times I've used this the high, because if it's really good, it really won't like to go back up into the full range of that. So using the very high of that, in my case, it would be fine. Not if you have this gap here inside the leg that has the stop hunt, because if you have that, then you could potentially see a whole return back up into this, and maybe a little mohawk, a little tiny little spike above outside with the wick of the candle, but the body be inside or below that gap. So that's all part of stop management. So I tossed that in there with no extra charge. But that changes the state of delivery, meaning that we went up to stop out, and then This is where everything algorithmically changes. Now we're going to start going lower. It's going to seek sell side liquidity. It's going to reach for sell side. It's going to expand lower. So you want to key off of and look for turning points, or what will be future entry points for you, Caleb, for trades that key off of these sell side imbalances, buy side inefficiencies. Every single SIBI, every single short-term high. So why do you want a short-term high noted? Even if it's a singular one. Because there's stops above that. Okay? We already have a relative equal high here that formed, and it caused a potential reversal that moves lower, that seeks liquidity. We had relative equal lows here. It traded down through that. And then we had all this business in here. We swept below that here. Actually, it's kind of sloppy, isn't it? And it's 9:40. Well, whatever. You're not paying for it. I'm giving you something extra. I wanted to be done sooner. My wife's probably thinking, hey, every time he says he's going to be this much time, it's invariably going to happen. If I say it's going to be a little one, it's going to be a long one. But I really can't do a 2-hour one today. So we'll probably end up doing a 2-hour one. This guy's bipolar. And he says one thing and the next minute he changes his mind. And that's what it's like being in my mind. It's a beautiful place. So every sell side imbalance, don't see anyone in here. Yeah. Notice how this one here, what is this one? What's this fair value at? By classification and name, what would you call that one? So buy side imbalance, sell side inefficiency. Okay. I'm not looking at that one. I won't highlight that one. I won't extend it forward because it's against the underlying direction and the state of delivery, which is it wants to go lower. So if it wants to go lower, I'm not interested in this unless it shows me that it wants to reverse and it's done something very violent down here. Like it could do it here. I'm not saying it will, but if it did something violent and started to reverse, then I would draw my attention to this one, because then I could act on that as an inversion fair value gap, because it would reverse its role. But right now, when the narrative is in motion, every sell side imbalance, buy side inefficiency, I'm referring to. I'm not always drawing them out on the chart, because as you'll see, it can be rather busy on your charts, and I like to keep things naked but not afraid. And you can see it trading up into the consequent encouragement of that one. So when you're trading, when you're observing price action, you're spending your time not pushing a button trying to trade. You're not trying to convince people in live chats in their chat window. You're not trying to tell influencers what you think is going to happen because you're going to wait for a high five, like, yeah, bro, or yeah, sister. None of that stuff. You're in your own little bubble every single day, and you're looking for these things to unfold. Now, if you recall, I mentioned yesterday, let's do that right, Michael, come on. At 8 o'clock is the same thing. There's another point of confusion I want to clarify. I talked about the first 30 minutes after 7 o'clock and after 8 o'clock and after 9 o'clock. That is your pre-session range, okay? It is 30 minutes of you expecting something opposite. So in other words, if you see relative equal highs, what would you expect after 8 o'clock? You would expect a low, or a price run lower. What is that by definition? Opposing directional run that's against where you think it's directly going to go. That's a Judas swing. That's manipulation. It's something that goes against the grain of what you're expecting. Not what everybody else on the internet's doing, but what you're expecting, okay? If you look around yesterday, everybody's titles on YouTube had stock market crash. And I was in here telling you it's going to go up. Was that random? No, because everybody had the same idea. And I sat down with you and explained to you this is what it's going to do. And we wait for it to present itself. And then we put in motion a plan of where the next foothold or the next grab point, like rock climbing. Okay, a rock climber looks at the surface of the cliff that it's trying to climb, and he looks or she looks and tries to map out a pathway. Okay, I am not going to just reach up for this grab point here with my hand and pull myself up a little bit and then guess where the next handhold is going to be. They try to map out because they don't want to get to a point climbing up using all that energy and then find out they're really not in a position to grab onto something that's more efficient for the climb to go back up. Well, in this case, we have a descent. Even though they were not trying to trade relative equal highs and lows prior to 7 o'clock in the morning. If this does this and it starts to move lower, you have to incorporate the range. What range is that? The low that was formed prior to it crossing the threshold of 7 o'clock in the morning. So we have all of this run here. So every single one of these inefficiencies over here, 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 even though it's been used already, you extend them in time. And they will be places for you to anticipate price going up to and pushing into it and then resisting and going lower as it works and gravitates to that low right there, as I was hinting at earlier. But the range, okay, the pre-session or pre-market range after the top of the hour, whether it be 7 o'clock, 8 o'clock, or 9 o'clock. These are your 3 windows of opportunity. So right away, we can study and see, okay, there was really nothing in here except for these 2. Right here, these little small little ones. So what did it do? It rallied up. Where'd it go to? Some random level. Nobody could have known that it was going to go to that level. But now you do. You have a stop hunt. The market broke down. So this is a shift in market structure. Okay. And this is a optimal trade entry. Even if you didn't have all the stuff I'm teaching you here and amplifying it, you already know this. This was the flagship pattern of my channel since 2012. The optimal trade entry. A shift in market structure. Measure your high to your low. 60 to 72% retracement. 62 to 72% retracement level. And 70.5 level. See, this is one of those moments where I would hit Control and tap M, and I would have to go back and listen to the audio and edit and fix that part. But it's live, so I have to keep going. My OCD is tapping me on the shoulder. But this is still a pattern that you would have traded anyway with using the rudimentary level lessons that I taught over a decade ago for free on this YouTube channel. But now you're learning the signatures that present a greater degree of precision and managing your expectations in the narrative. How are you going to incorporate all these things and trust holding on to a trade? So now we're going to go into we have a hang on, I got distracted here. I have headphones on, so when I was listening to a phone that's on Do Not Disturb, I was still getting a flash on the screen. And I looked at it, made a mistake of looking at it, so that broke my concentration. But each hour at 7 o'clock, in this case 8 o'clock, and at 9 o'clock, what you're doing is you're starting the whole process all over again. You're waiting for relative equal highs to form or identifying relative equal lows. At 8 o'clock, you can look prior to 8 o'clock. You just can't look prior to 7 o'clock for relative equal highs or lows because you're trying to work inside the range of the morning session. Okay, the morning session is essentially 7 o'clock to 11 o'clock in the morning. Technically until noon, but 11 o'clock for me. I like to be done by then. Frankly, I like to be done by 10:15, 10:30. If I can get something on and be paid out, I'm done. I don't need to do anything else. You may not like that. You might want to be for the whole day. Not me. I don't want to be in front of the charts. I don't like to be chained in front of the charts. But once you have a turn in the direction like this, and the market's likely to draw lower, you'll see that by focusing on only one side of the marketplace with the inefficiencies, as we have here, it's moving lower. So every SIBI is extended to the right. Okay, if you remember on Twitter, I would tell you note a specific fair value gap, and I'd say extend it to the right. That's this. That's me doing this here. Okay, and whenever you see the market trade, through them a little bit, you'll see a troll or someone that has no idea what the hell's going on. They'll say, "Oh yeah, he thought it was going to sell." That's not what we're doing here. You're going to wait for it to cover over top of it and then break back down through it. And then it will act as what you expect it to do. Many of you, when you see me talk about inefficiencies, fair value gaps, SIBs, BISTs, all that business, you anticipate that, oh, it's a matter of just going up. Once it gets into here, all you got to do is sell short right there. That's not it, folks. you have to anticipate a measure of manipulation. What was the price doing here? I told you it was getting kind of sloppy. We had this inefficiency, yeah, but what else is there? What else is there? You have this energetic drop that created that SIBI, and there's going to be what trailed there. For anyone that's short, they're going to put their stop loss right there. Well, that efficiently been removed with this bump here. Back into an old SIBI, and then you have a market breakdown. Look at the work around the halfway point, which is consequent encroachment. The market drops, opens again here, breaks lower. We have an inefficiency. The bodies are telling you, yes, this is going to go lower. Why? Because it stops right there. See that? The wicks are allowed to do what? A little bit of damage. Is it going to random locations? No, it just bumps the bottom of that SIBI over there. Right there. And then works lower. Now, at 9 o'clock, the same thing. You can look at any relative equal high or low prior to 8 o'clock up to 7 o'clock. If you're going to be trading with longer term price runs, for the folks that are asking me, how do you hold on for longer trades? In that case, you're going to have to look at the previous day's range and what is the previous day's low, or if it's going higher, what's the previous day's high, and that's your next logical level to reach for. But I don't want to give Caleb anything beyond the scope of what I've already covered, because it's giving him way too many things to worry about. And if you're brand new, you're probably feeling that too. But in short, what you're doing is at 7 o'clock, that starts the hunt for relative equal highs or lows. If you see a disruption like we were talking about yesterday, where it's jagged, you see how it's nice and jagged? That's indicating it's probably going to go the opposite direction, especially if you have all these other supporting factors where that would have been a breaker. This is obviously a high probability inversion fair value gap, and it hits it here, respects consequent encroachment, breaks down, and then we have another return in here. Here's the optimal trend entry as well. And everything is, your mindset is, okay, I'm looking for lower, I'm looking for lower, I'm looking for lower, and it breaks lower. And then you highlight every single time it creates an inefficiency where it's a big candle that doesn't have any overlapping with the candle prior to it forming or the candle after it. So it creates that inefficiency, that imbalance. And then when you have these long protracted consolidations like that, it's really better for you to sit still. Let them do whatever they're going to do. Why? What do we have there? What did I say yesterday? We have relative equal highs and we have relative equal lows. You're going to be playing the breakout game. And I'm not a breakout artist. I'm not trying to guess. I want to see what the market's going to do. So by this run up, it can trade into any one of these fair value gaps in here. It does. And does it fall out of bed? Yep. So what I would require, and you've heard me say, well, not technically you heard me, you'll see in old tweets where I'll say, we want to see this fair value gap as an inversion fair value gap. Well, that means it ran above it. It's got to go below it and then do this right there, that function of redelivering to it. Then a deeper protraction lower to upset any liquidity that would be resting below here, as much as, and to the degree of reaching down into that low over there, because that's the low in London. You see that? So when you have your charts, Caleb, what I'm only interested in seeing anything before 7 o'clock if the range of the morning session trades to the London session low or the London session high. Other than that, I don't want to see anything on your charts beyond this. Okay, that's it. So all your charts are going to have about 6 o'clock or so, just to get a little taste of what London was doing. And then everything else in your charts needs to be very, very simple. But I want 9 o'clock delineated, 8 o'clock delineated, and 7 o'clock delineated. In any formation of relative equal highs or lows, I want you to annotate them. Okay, and the way I want you to annotate them is, don't use this. Don't do this. Okay, I want you to draw hold down shift as you drag it over, it'll keep it straight. And I want you to annotate it like that. And choose whatever color you want. It doesn't matter. Don't, just because Dad's using this color, I'm just sticking to this color right now because it's saving me some time. May not feel like it because I'm taking more time than some of you guys are wanting me to spend doing it. All right, and that's the relative equal lows and the relative equal highs. I said yesterday, when you have both of them, you wait. You wait for them to take one side out. What does it do? It runs higher. So what's it going to attack now? That one. And it runs down below it. Okay. So as it is right now, if there was any trade taken or no trade taken at all, you would do nothing because it's already done a whole lot of movement and it's back in an area where I wouldn't want to see it as a trade back in this civvy again, because we've already done once, twice overlapped it, respected it, and now we're back inside of it again. That is low probability, and it could fall out of bed and crash 1,000 points a day. It still wouldn't be a trade I took because it's against the rules of me wanting to use it. It's been overlapped and worked multiple times, and it's done enough. So your day would be complete here, and you would capture everything just like this, and then you would annotate it. Like this would be an area where you could highlight or type out any observations or what you felt about this movement here. In this little area here, you would annotate in text. So you would just take the text and say something like this, like, okay? And just simple little statements like this. And what you're doing is you're highlighting your focus here and here and here. And up here in this segment, you can do something like, I like how it reacted off that inversion fair value gap. So what you're doing is you're cherry picking points of reference for your journal. And when you see the chart again, the next day, like tomorrow, when you sit down, you look at price action, you refer to what it did yesterday. And these levels will be subconsciously retained as significant, and it'll reinforce it subconsciously as a memory worth holding on to. And then when the weekend comes and you go back to your journal and your charts and you have these little annotations, what that will do is you'll read this comment that says, I like the obvious return of price